All right, Evan, what questions do we have today for the Q&A?
All right, so we got a couple. Let's start with this first one from Oksana. She was wondering, what does it mean exactly when a stock gets an upgrade or a downgrade? How does it affect the stock, and where is the best place to find this information?
So upgrades and downgrades is going to come from like analysts that, they think the company's going to be doing better, they're going to upgrade it. If they're going to be doing worse, they're going to obviously downgrade it. But the stock will react due to that, more so from very big companies. If Goldman upgrades the stock, it's going to be a big deal. If some like lower tier, third rate analysts upgrades and downgrade, it's not going to have as much weight. But what you will find is that oftentimes the stock the stock that has performed the best will have the most upgrades.
Yeah.
And it's kind of like I don't want to say
it's sort of a lagging indicator almost.
Yeah, so it's like then the stock is going to get smoked, and then when the stock's at 52-week highs, every analyst is saying it's a buy.
Yeah.
The stock's at the 2-week lows, they're going to switch it to saying it's a sell, which is just like completely backwards. Also, it's like a little manipulative where when the analysts like upgrade to downgrade a stock, their upgrades and downgrades go off like the prior day's trading. So when a stock say gets smoked on earnings and it gaps down huge, it's easy for analysts to come in and say, we're downgrading the stock now.
Yeah.
The stock was at 100 yesterday and it's at 50 now. Their rating is based off yesterday. So they get to like kind of hindsight trade their upgrade. So again, if you're in a stock and you get an upgrade, it's obviously going to be beneficial to you, but it's not really like tradable information or like you should be like wasting. It'll be like a little extra bonus if you're swinging a stock long.
Yeah. Yeah.
But I wouldn't be trying to like spend a ton of effort on it because it's going to be the worst, like the biggest lagging indicator humanly possible.
Yeah, I agree. And that's kind of what I told her when she asked me privately. And I explained, like, for the most part, the most beneficial time is like when you're already in the trade, you get an upgrade, the stock has a really nice gap up and you can sell into that strength. And that's kind of where that plays in. But to try to like follow analyst reports and then buy or sell because of those reports, it makes it a little bit tougher. So yeah, overall, I think for the most part, it's kind of noise and it moves things in the short term, because the retail traders, they see that. The average trader is like, oh, upgrade, like, let me buy this now because it's going to 150. It's at 120 now. Goldman thinks it's going to 150. I'll buy it now. So yeah, selling into that good news is kind of where that works, in my opinion.
That's right.
Next question we got was from Khan. He said, with all the interest rate increasing the Fed is doing, what does it mean to student loans? I'm assuming right now is not a good time to borrow since interest rates are high. If you had to take out student loans now, would you take out a fixed rate or variable?
So no matter what, you always take a fixed rate. Never, ever take a variable rate if you have the option. You really just want to lock your rate in. Even if, again, high or low is relative. Again, interest rates are high, relatively speaking, now than they were a year ago, but a year ago, they were the lowest they ever were in the history of the world related to interest rates. So if 20 years ago, you had mortgage rates at 18%, and then you had mortgage, I'm talking about mortgage rate again, I know it's what student loans, it's the same stuff. If you had mortgage rates at 18% back in like the 80s, now you had mortgage rates in the twos and threes in 2020, and now we're at 4 and 5. Yeah, it's higher than it was a year ago, but relatively, it's still an amazingly low rate. So people get kind of hung up on that, where they're like, it was 3% last year, now it's 4 or 5 now. It's like, well, you're here now. Like, do you want to go to school or do you not want to go to school?
Yeah.
And that's like, you're not really going to be shopping interest. It's like whatever the interest rate you're going to get offered. Again, it's not your money. If someone is giving you $100,000 to go to school, and there's risk involved in that. So you pick a fixed rate. You're not going to wait 2 years to save 1% on interest. Again, you're not going to accumulate interest while you're in school anyways. So it's until you get out, it's not going to really be much of an issue. And the government, the next time anything happens in this country, the fact that they kind of waived interest rates for 2 years, that'll probably be another thing they'll continue to do, where like anytime something happens, they're going to just run back to giving everyone 0% interest rates again. So I wouldn't get too hung up on the interest rates. Again, you don't want to have like an obscene interest rate, but it's going to, I would imagine student loans are probably in like the 5 to 8% range right now.
Yeah. What would you define as obscene? Like, what would be something that just doesn't make sense?
I honestly don't really know interest rates on student loans like that well. I haven't really seen anything too crazy. Again, for the last 2 years, pretty much most people had 0%. Like the government just like
Yeah, they were just like
0%.
pause for now.
But the dumbest thing I think that most people did during that time was they didn't pay it, which was just like kind of stupid, because you have a period where any dollar that you put towards that amount would actually go towards the principal, and you could dramatically lower the loan that you had.
Yeah.
Like almost every person I talk to, they're like, it's 0%, I'm not paying anything, or I'm paying like $20 a month. And I'm like, that's so stupid. Like, if you have 20 grand in student loans at 0%, and you were paying, let's say it was $500 a month before, but 300 of that was probably going to your interest payment. Now the full 500 is going to that. And if you made that same payment for those 2 years, your $20,000 student debt is now 12 or even less.
Yeah.
And that's where like there's all those like I've seen a couple things on Twitter where it's like people who have like these obscene student loan balances. When it's like in the hundred, once it gets over 100,000, you're really like you're pretty screwed. Even at like 5% interest, you're talking $5,000 a year in interest. You're talking $600 a month in interest that you're paying, or $400-500. So if you have like a $700 a month student loan payment, 500 goes to interest. You're only paying $200 down. So
That's crazy.
Your $100,000 student loan balance went down to 99, but you still $6,000 to pay $1,000 off. But now when you have these 2 years of 0%, you pay the same 6,000, your 100 goes down 96, then down 92, and so on and so forth. Unfortunately, everyone that I really came across didn't really take advantage of that, or didn't see it beneficial.
Well, that's because it seems like it's laid out in a way that they wouldn't see it. And I guess that's kind of the whole point, right? It's like, we're forgiving your loans for the next 2 years. You don't have to pay them, when in reality, that's actually the best time to get aggressive. And as long as you're making the same amount of money you were making 2 years ago, you just continue those payments, then, your principal goes down. And then that in turn, your interest rates, you're paying less in interest when those interest rates come back.
Yeah.
That's
the only other thing, like on like Khan's broader question, would be like, I know he goes to the city in the school. Like if he lives in the city already, it's like obviously don't get housing. Like try to like make your college experience as affordable as realistically possible.
Mm-hmm.
Even like for me, like I commuted when I went to college, and I had friends who lived in the same town who stayed on campus, and I graduated college with $20,000 student loan debt. My friend graduated with 150, and we had the same experience. The only difference was he slept there 5 nights a week, because it was like they called it like a suitcase college, where like on Fridays everyone went home, because most people like lived in Jersey. Most people were like South.
Yeah.
But like me and him were pretty much on campus the same amount of time. Granted, I didn't sleep there every night. Some nights I did, but like I left college with a joke of a student loan.
Yeah, and he spent $130K to sleep in a dorm room.
But yeah, pretty much. And it's like I slept in the dorm too, because he didn't have a roommate. So it was like I got to sit for free. But he's still paying that debt off, where I was in a situation where I pretty much kind of paid it off kind of within like a year or two. But he's still paying that, like whatever it is, $700-800 a month. And it's still a significant sum. And we're talking 7-8 years later. And that's from where your money is going. It's like it's going to that for the next 20 years, because you can't really get ahead of that unless you start making crazy money and actually wanting to pay that stuff down.
Yeah. Is that, so I'm not sure if this is true or not, but so should your student loans be one of the first loans to be paying off, or one of the last ones if you have other sorts of debt?
So the simplest way is you just kind of, like the debt snowball is you rank the smallest debt to the largest amount. So the student loans is probably going to be at the last thing you pay off. Because if you have like a credit card bill with $1,000, like a $1,000 credit card bill, $5,000 car loan, and $100,000 student debt, it's like that $1,000 credit card payment, a $1,000 credit card balance, it's got $100 payment. You'd rather knock that off entirely, and you could take that $100 and put it towards the car loan, and then you got the car loans, whatever, $400 a month. Now you can make a $500 payment there. Takes you a year. Now these two things are gone. And now you can take that additional 500 and put it on top of whatever you're paying for the student loans. And that's just like the debt snowball, just whatever the smallest debts are first, that's what you want to wipe out. You can free up those required minimum payments or whatever payments you were making. And then you just like keep adding those payments you were making to the next bigger sum until you kind of work your way down the list. That's just...
I've been getting a lot of mail and advertising for like debt consolidation. Are those usually a trap? Like what's the deal with those?
So it's hit or miss. I know, like, I think a firm is probably one of the best ones that I can think of, or the easy,
Affirm?
what they offer. Like you just pick,
Mhm.
it's relative. You can't just put you $1 million and mail it to you. But
Yeah.
some of them, you have to check the fine print. And the only real fine print is like the prepayment penalty. And I get them too. I get those things all the time. And
Yeah.
sometimes I'll read them just to see. And the ones that are like crappy, it'll be a fixed amount. So it'll be like, we'll give you 100,000 at whatever, 7%, but the payment is fixed at this rate for the duration of the loan. Usually it's like 10 years. So there's like it's this fixed rate of $800 a month. So they know on their end, it's good for them because they know they're going to get 8% a year on that balance for the duration. And they do that because they don't want to give you the 100,000. You go, whatever, you go buy a Porsche and you sell it for 110,000 and you pay them back immediately. And then they off you. So it's not, I don't want to say it's like scrupulous that they're doing it, but like they're also not trying to like give away free money. But
Yeah.
don't do that. It's just like I've seen some that it's like this is a fixed amount and you can't prepay it. But most of them, if you read the fine print, it's like there's no prepayment penalty, and then it's fine. And it's again, if for Khan, if he graduated college with $200,000 student loan debt at 5% or whatever the rate is right now, and then this company's offering you 2%, then yeah, it's a no-brainer. But it's not. It's more so for like credit card debt. It's like if you're at 19%, 29%, the highest like legal interest rate that I think anyone can really charge right now, that's where it makes sense because like you're paying 30% here, and now you might get 5 or 6, even 9. It's a big spread there, and if it's a bigger sum, it can really be a big cost savings. So it's more for consolidating credit card debt, not really student loans is going to be very quick.
Yeah, no, I didn't think about student. I was just thinking about debt in general. Okay, cool. I've been getting a lot of questions about the housing market. I'm 28 years old. I have a lot of friends that are in the market to buy a house, but they're not sure whether to, hold off for now. Cause like we were just saying, mortgage rates doubled in the last year, even though, like you said, it's relative. But I don't know, do you think it's better for people to hold off right now? Do you think that like markets are going to be more viable in a few months to a year or 2 years?
So I think, again, housing is obviously not our skill set. I do have, again, my mother's a realtor and I have a lot of friends that are in that space. So I get to, bend their ear quite a bit. Again, for housing, for most people, you're going to be in the home for a very long time. You're not kind of swing trading a house where people always say like, I'm going to wait for like the market to crash. And it's like, they're kind of full of shit. Even now it's like in the beginning of the year, everyone couldn't wait, or not everyone, but most people would be like, I can't wait for a bear market to like pick up all these great investments. And it's like, all right, well, we're here now. And there's great opportunity, like great long-term opportunities here. But now it's the opposite. It's I'm waiting for it to get safe again. So I think when people say like they want to like wait for the housing market to correct, it's like you're never going to catch that. And even if you do, when that does happen, you're not going to want to react. Even the beginning of the pandemic, that like first month or two, everyone was like freaking out. And then it became like the biggest boom that really no one kind of saw coming. I don't think anyone really expected real estate to go that crazy.
Mm-hmm.
The only thing I would say is like with interest rates, again, right now interest rates are probably like 6%. And again, like I refinanced my house at 3%. And I literally like was like trading the 10-year. Like my lender's like, it's a great day to lock. And I'm like, no, it's not. Like we're bull flagging. Like I'm seeing this, like this is not the time I want to lock my rate. And I waited like 2 months and I literally locked it like, I forget where it was, but it really, I was like watching the 10-year and then I was like, this is the day we can lock and you can do it. And again, he wants to just sell a loan. So every day was a great day, but that's the one where if you could, we talked earlier in the pre-market call where like this 100% move in the 10-year in the last few months reminds me just like energy. Energy had this 100% run up. This is the same percentage increase. Again, energy versus 10-year interest rates, very different, but chart wise, same percentage run up. And then it has this second kind of blow off top run. That's like when everyone kind of chases in, and then like the trade kind of fails. And then it's now the hard trade, and now it's lower highs, lower lows, and rolls over the 200-day and kind of back to earth. And my feeling with the 10-year is kind of the same, that this percentage move has been so dramatic that, again, maybe it pushes a little bit higher, but eventually it's going to lose a little bit of steam. And when it does start to roll over, that's more when you can get, you're not going to really see interest rates or mortgage rates kind of below 3%, probably ever in our lifetime. I don't think we're going to see those at crazy prices, but I think if you can get a mortgage under 4%, above 3, under 4, like that would be like a sweet spot where it's, and that could be in 2 months, it could be in 6 months, that's anyone's guess. But I think if you can kind of lock in a rate in that range, you'll be kind of set for life, interest rate wise. Like you'll never have to really refinance. And that was, again, the biggest time to refinance was the last 2 years. And we have members now that are mortgage lenders. Blake's one of them. And he was like, last few years were insane. And now it's slowing up because you have to almost be an idiot to refinance at 6%, because there really was, you weren't getting a 6% mortgage for the last, almost a decade. So there's really there's no refi business left, because everyone is, or most people took advantage of these 2-3% interest rates, myself included. Like when I bought my home, I was at 4.5%, and I refied it down to 3%, and it was what was it? It was like a $600 a month savings, but I still make the same payment now. So it's like,
right. So you're just paying it off so much quicker.
Yeah. So like the student loan person, it's like they got that free ride, and they're like, all right, I can spend the $600. And for me, I was like, no, I'm going to still pay the same that I was paying because I was already used to it. But now that extra 600 goes towards the principal, and will pay it down way faster than me taking the money and doing whatever I want with it.
Yeah, that's a good lesson there. Play offense on your interest loans if you have them. You gotta every time the man wants you to take a break from paying them, or tries to give you some time to ease off of them, that's when you really got to hit the gas and even up your payments if you can. Those weekly deposits into the long-term stuff, same thing. Cool. No, that's a lot of great info there.
And one last thing with student loans, most places you can do weekly payments as well. And the one bigger difference between a mortgage and student loans with weekly payments and any credit card, any debt except for a mortgage, is that for a mortgage, you can pay weekly and it's beneficial, but you will not see the weekly payments on your statement. You'll see that the payments go on, but you'll only see one actual debit monthly when there's enough to cover the principal payment. So say it's $4,000, your mortgage payment's $4,000, pay $1,000 a week. The $1,000 will come out each week, but the mortgage will only apply a $4,000 or greater payment.
So does it even make sense to go weekly? Like, does it make a difference?
Because over the year, you're going to make that extra payment without really even feeling it. And that's where it's like there's going to be one payment at some point throughout the year that you're going to make an extra additional principal payment. And that's that's the part that's why it makes sense. But for all other debt, student loan debt, car loans, credit cards, the day you make that payment is applied. So for the student loans, if you're paying $500 a month, you can pay $125 a week, and you're going to be making those principal payments with and interest like exactly the time they go in. So you're going to be chipping away at that balance, small increments, but much more consistently. So it's going to go from 100,000 to 99.9, 99.8, 99.7 versus the 100,000 to 99.5, 99. But those small increments, it will accelerate it, not as dramatically as a mortgage, because the mortgage is such a bigger sum, but it always will be much quicker.
Yeah, every dollar counts. And that's all I got, Ben.
All right.
Yeah.
All right, buddy. Well, it's good talking with you. And
yeah. Oh, by the way, reminder, guys, if you're watching this, we still have some Rolexes. We got a few spots left. So if anybody's interested, you can message me. You can message Ben. Comes with a really nice watch case as well. There's 3 spots in the watch case. This is the first watch, so we'll see what others Ben can create. But yeah, and that's it.
All right, guys. We'll see you next week.
Yeah, catch you later.